from Azets, new members here today. I had a slight look of fear when I looked in the programme of today's event when it said fireside chat, which instantly filled me through with dread. You have visions of Bing Crosby, thick jumpers, roasted chestnuts. Unfortunately, it's nothing like that. The bad news is, this is a very short talk on tax. The good news is, it's going to be very quick. Okay, so just bear with me over the next 15 minutes or so. So firstly, just in terms of who are Azets, and my colleague Sam came up earlier and gave us a bit of an overview. But we are a firm of accountants, based locally, accountants and tax advisors, based all around the UK, 88 offices, large presence in Scandinavia as well. I'm actually here from the Egham office, the Heathrow office, as it's titled. We've been on patch in Heathrow since the early 80s under various different guises, Barron Ross Bass, Wilkins Kennedy, and now Azets. And the reason why we're getting involved today in Cummins is that obviously we act for a number of businesses in the logistics, freight, courier, consular sector. And we're really looking to try and develop those relationships further, and obviously see how we can add value and hopefully develop those relationships and work forward. So I guess at the risk of being booed off this very short stage, I'm going to talk a little bit about the autumn statement. We've already had a couple of trails for that earlier on today. But I just want to pick up some of the points that came out which would impact you as either a business owner or perhaps head of a department and looking at your workforce. So in terms of business tax changes, which I'm going to go through, and just to say that I wasn't, if you have got any questions, we'll be around afterwards. Some of my colleagues are down the front there as well, and we'll be here for the networking. But in terms of business tax changes, I suppose the things that didn't change, so corporation tax didn't change, so that's set at 25%, that went up earlier this year, which was a bit eye-watering for a number of small businesses. Now if you then break that down, hopefully you can see the slides at the back in terms of how this works. So you've got different grades of salaries on the left-hand side. So if you've got a factory manager or a warehouse manager on 30k, you've got the impact of the employer threshold change, and you've got the additional national insurance on top of that. So you've effectively got another £866 a year you're paying for that employee. If you've got a sales director that's well paid on 80,000, the impact is even greater at £1,500. So some quite chunky numbers there, just that have arisen from this increase in employers' national insurance, hence why it was mentioned earlier. So how does that work in terms of looking across perhaps your business as a whole, or indeed a department you're in charge of? With this slide, really looking at your total wage bill on the left-hand side. So, what your wages cost is, and I've just put sort of an example of number of employees and what the impact would be. So I was with a client yesterday, wage bill around about the £600,000 mark a year. Their additional NI cost will be about 12 grand a year. And obviously as you get more into the corporate levels, we talked about the payroll bill about 1.5 million, you're getting to 33, and obviously it goes then well off the scale in terms of where that goes to. It's not a very upbeat slide, obviously, but just in terms of being able to see how it does impact on you and how it then impacts on the business, there's some chunky numbers there in terms of how that then works. And in terms of then picking up a couple other changes that came through, I'll just briefly mention national minimum wage. There were some increases to the rates there, which are in the middle of the board. I suppose this is probably more relevant if you've got lower paid members of staff and apprentices as well, because it's a trap you can sort of inadvertently fall into if you're not aware of the rate changes. So at the moment, if we're picking a 21-year-old earning £11.44 an hour, that's going up to £12.21. So once you factor in the employer's NI cost as well, there's an additional 10% on their actual wage costs. So it's actually a reasonable number. So I suppose I'm just mentioning that just so you don't fall foul of this. I say this having nearly done it with a few of our trainees that come on board for school leavers. So just being aware of that and obviously the employment law aspects of those changes. So what can you do? This is all very doom and gloom, but in terms of things you can actually look at in terms of doing, think about the impact on the business overall in terms of recruitment. So with that change, can you afford those extra jobs? Where you have leavers, is now the right time to replace those leavers? Can you look at other capacity within the workforce and maybe look at flexible working? If you have plans to perhaps increase your employee benefit package? You know, do you now park those bits, or do you actually ramp them up to try and get people on board? Looking at labour models, and I'll stay clear of IR35, but do you outsource more services? If you're outsourcing to an external third party, you haven't got that additional employees NI associated with recruiting an employee. So just a few things to bear in mind there. I suppose in terms of practical points going forward, I'll come back to the full cost impact in a moment, but just looking at different ways in which you can pay employees. And a couple of obvious ones are things like salary sacrifice arrangements. So looking at perhaps pension swapping ideas that would reduce the NI bill for both the employee and the employer. And looking at other salary exchange arrangements, such as looking at electric cars. And I was just on that point, I was just going to pick up on the electric car point, because it was mentioned earlier on today. And we obviously did part of the quiz earlier, learning about when we're going to get to electric vans, number of percent by a certain time. In terms of electric cars, and I've just flagged this up just so you can see where HMRC and the government are going with the taxation of this. A lot of you will be aware of this. I picked Jaguars and Range Rovers, my colleagues pulled that together. I'm not advocating any car here today, just to give you an idea. I think the main point that comes out of this is if you take 3 cars with fairly similar list prices, different types of vehicle, electric, hybrid, petrol. So hopefully you can just about see at the bottom the effective tax on those different types of vehicles. So if you had an electric car, for that particular vehicle, it would be £840 worth of tax to the employee. If it was a petrol one, it's £9 grand. So there's a massive increase and a massive incentive to employees not to have those. And obviously you then got the associated employer cost that goes with that. So it's all part of the agenda about trying to push electric cars and looking at those benefit in kind rates, because you can see the benefit in kind rate, which is assessed on a list price, 3% for an electric car compared to 37% for a Jaguar F-Type. And linked into that, which may or may not be relevant, I mean, a number of businesses that we've dealt with, not just construction businesses that are getting double pickups, getting pickups and then Ford Rangers and Navaros, getting them souped up so you can put your kids in the back and things like that. The taxation of those is changing from April 25 as well. So for any new pickups acquired after April 25, there will be an additional tax associated with that, because they'll go from being taxed as vans to cars. So if you've got a new vehicle, a new pickup acquired after April 25, effectively you've got another £6,900 worth of tax payable by the employee. So it doesn't affect ones you've already got, but it will affect any ones going forward. So it's just something to be mindful of if you've got, within your own fleet you've got some pickups, or if you know companies that have got that, just to be aware of that. So just some final bits in terms of the actual NI side of this. So again, the main thing is really to understand the full cost, and you would have conversations no doubt with your own external accountant and in-house accounts team, but just to try and establish exactly what this means for you as a business, or as indeed as a team, and what the impact it might have on you. We talked earlier about margins, squeezing margins. Obviously everyone in this room is affected by this pretty much. Obviously you've got less employees, it's less of an issue, but most people will be impacted by this. So it's how, as a business, forget the tax side of it, how do you counter the increase that you're facing there? So have a think about that. Price increase pricing is probably not possible, but have a think around how you can actually maybe deliver the service in a different way, but just be mindful of that. And obviously looking at different ways you can perhaps incentivise staff and bring them on board. The main thing about this, because it is very different, is just the awareness piece about it. You just see rates on the page, and it's actually, what does it actually mean for the business? I think the main thing I would actually advocate is to quantify it for you, so you know exactly what you're looking at. Okay, so we'll move from national insurance to two other exciting areas of tax: capital gains tax and inheritance tax. Now, the reason why I think these are relevant for the people, but just as just give you a bit of background, there was something called entrepreneurs relief, something became business asset disposal relief, whereby you only pay 10% of the first £1 million of the gain you made if you sold your shares in a private company, subject to various conditions. So that's changing. So those rates are now changing now. So it's just being aware of the fact that, one, the rates are changing, and two, they are changing at different points. And I suppose just taking this very crude example, if you and your fellow shareholders sold your company for £2 million, if you were selling it now because of the rate change, the tax would be about 340,000. If you sold it after April 26, it goes up to 420,000. So there's a massive amount of increased tax liability there. Now, obviously, you can't impact on the rate. But I suppose the point to take away from here is if you've got an impending sale, if you know someone who's in the process of trying to sell their business, try and get it done as quickly as you can. But equally, if it's being dragged out by a purchaser, have a little think about the impact it means if it goes past certain dates. Does it become a negotiation point as part of the sales price to say, actually, I'm going to be facing more tax? So can we look at the price you're going to buy my company for? So just relevant, again, if you've got shares in your own company, or indeed people that do so. Inheritance tax, isn't it? So just some final points from me. We've talked around a lot of different taxes, I suppose, starting with the business asset disposal relief point. Again, just make sure that if you can if you are going through a sale process, try and get that through as quickly as possible, as practically as you can. From an IHT perspective, make sure you're aware of the exposure to your estate of any changes to business property relief. Spend your pension first, so get that out, so that is more efficient from an inheritance tax perspective. Housekeeping, such as making sure your wills and your power of attorneys are up to date. One of the other areas that some of our clients have looked at is also looking at insurance products. You may have seen this, we've spoken to your financial advisors, where you're now facing an inheritance tax liability as a result of those changes. Is looking at trying to get a premium now that might cover your beneficiaries by getting up a policy that will pay the value of that inheritance tax to a trust on your death. So again, it's just something that might just lessen the impact on the people that you leave behind. So just think about that from a planning perspective. And I guess in national insurance, so the main thing is really just to make sure you know what you're looking at in terms of worst case scenario and you can plan around that, because from a non-tax perspective, looking at budgeting and what that means, you might be going into a year where you're thinking, right, we're looking at overheads in this respect, direct costs, income levels, break-even lines, certain margins. This will have a bearing on that. So it's just making sure you're aware of what you need to tweak to make sure you get to the return you want to do. And then going into your staff proposition, generally we know how difficult it is to recruit and retain staff, but looking at your proposition, do you do some sort of salary sacrifice arrangement, EV cars, and just looking at the proposition as a whole, what makes you the right employer to go to as a potential employee. So that's it from me. So thank you for bearing with me. It's always an exciting thing talking about tax, and I'm not a tax expert, but thank you for staying with me. If you have any questions, I'll be around for a little bit afterwards, and enjoy the rest of your day.
Thank you very much indeed. Probably one. Just one minute.